Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today, Viatris Incorporated had earnings. So, we're going to take a look into those and see how the stock is doing and what to think about it going forward. We last looked at this stock a few months back, um, back in May, and it was one of the rare cases where we gave a stock a sell rating. And I still hold that rating. In fact, I doubled down after these earnings, and we're going to get into why. But the stock has made some moves since then. It has gone up 12% since that rating, but it's still holding down here in these levels. It does not have any sort of momentum to push back 12, so it's not likely to go much further than this. If we zoom out and get the bigger picture of the company, you can get the full scope of how poorly the market looks at it, as they should, because when we get into the financials, right off the bat, we don't want to be investing into a declining company. And the fact that this company has been on the decline since 2021 with their revenues, and even before that point, they were awful financially. So their peak was in 2021, $17.88 billion in revenue. Last year, they came in at 16.26. And this year, they're expected to do 15.6. So we see some pretty strong, consistent declines across that. They're basically on track for that. In fact, they're coming in a little low on these expected declines. So it might decline even further than that. And next year, the analysts' expectations are even further declines, bringing it down to 15.3 billion. So right off the bat, with top line revenues looking like that, there is absolutely no way this is getting a rating aside from sell, because there's too much risk involved. Now, could it be a hold? Potentially, because it is undervalued. We do see that the stock has metrics suggesting that it could be valued more in the high teens, low 20s, uh, off of this year's expected numbers. We'd be looking at $23.30. And then we'd be looking at a margin of safety to get into the stock at $15.31, and time to reevaluate at $19.91. But if you look year over year at these numbers, at the end of last year was 23.51, so we get a 20-cent decline in fair value. And then margin of safety was 15.45, so we get a 14-cent decline in the margin of safety. And it continues on into next year. We see another decline of 60 to 70 cents in the fair value, margin of safety, and overvalued, time to reevaluate. So the fact that we're seeing year over year declines, if it were showing slow growth, it could potentially be a hold with the undervalued that it's currently at. But the fact that we're seeing consistent declines across the company. Now, they did finally have positive earnings in 2022, but that's looking like it's on the way to decline. Before that, they had 2 years of negatives, over $1 of negative earnings. So ever since they branched off of Pfizer, they've had a rough go. Pfizer definitely just threw out everything that they could to help bolster their main business. And we just looked at Pfizer the other day. It got a buy rating because they are showing some pretty good potentials. Now we'll have to dive in and look at not strictly the fundamentals of the company, but to do a quantitative analysis as well and see what do they have in the pipeline to help them grow further. But for the expectations for the next 2 years, they're looking very good, especially at the current stock price that they're at. Now, we can do a head-to-head between Pfizer and Viatris to understand why Pfizer is on the buy list while Viatris is on the sell list. But just looking at some of these numbers here, they're basically spot on for a lot of these things. They do seem to be coming in a bit higher on gross profit, but their total expenses are definitely killing them because their expenses as a portion of revenue so far this year are 93.61%. They have had years where in 2020, their expenses were 100.86% of revenue. But for the most part, they've been in these low 90s, and that's just incredibly high. Coming down to net margins of just tiny, tiny bits mixed with years of negative margins. And that's not a way that a company can grow and survive. Now, can they turn things around and potentially become a buy down the road? Yes. And we'll keep monitoring this because this is clearly a stock that you guys are interested in from what I saw on the last video that I did on them. But we can see earnings yield, very good. Free cash flow yield, very good. And that's the main driver here. Their balance sheet and their free cash flows have a lot of value in them, but it's the actual operations of the company that are on the decline that are going to drag everything down. And the market has identified that and has punished the stock. Some good news that has changed since the last time we took a look at this stock: shares. They are, it seems, in the process of buying back shares because they did go through a stock split back in 2020. That's why we see the shares double here. And then they issued even more shares. And now that is starting to decline again. So the share count is currently below where it was sitting back in 2021 after that stock split. And one huge place of concern for me was the tangible book value. That I don't know that I want to scrutinize too much what is tangible assets versus total assets. The assets trend has changed though. They have a decline in their assets, moving from 50 to 48.7. And their liabilities are on the decline as well, moving from 28.9 to 27.6 or 27.9. I think all these graphs will really help show the picture though. So we see some growth from 2019 to 2020 in the revenues, and then a decline ever since 2021. And if we were to draw a new line, it would just be declines over here. The cost of goods just kind of ticking up. 2021 was an exceptional year. And so while the revenues are declining, the cost of goods are climbing. And then we get to the gross profit, net profit, and EBIT, and we see just declines in net profit up until 2022, where they had a decent year, which then declined into this year off of their guidance. And then we have the gross profit, which peaked and is going on the decline. And that's the story across the company. We see ups and downs across the balance sheet for both liabilities and assets. And there was definitely a huge jump in the liabilities going into 2020, and those are showing a decent decline. But we have a bull shape for the assets, so we're hoping that they're going to grow them how they had in the past. But with how they're going right now, there was some decline. So this would be, if we were going by the actual number, this would be down lower. Cash flows, they're holding them very steady at 2,500 or 2.5 billion. They came in with that in 2021 and 2022, and their guidance is the same this year. And they're actually a little ahead on that goal. Dividends, they have very strong cash flows. So If anything, this would potentially just be a dividend stock. And they've been decent about growing that. They didn't start until 2021, and we don't have a whole lot of history here to see what's going on. In fact, we haven't even seen any announcements of raises for this year. We're halfway through the year, so they might pause at the current level, in which case I don't know what kind of investor would be looking at this stock aside from someone who's very risk averse who thinks that there could be a good turnaround. And then we get to the graphs of all the valuations where we see that the share price was at a decent point, uh, all things considered, from 2019 to 2021, and took a dive in 2022. Going forward, it's now the lowest metric. So this shows us that stock's probably undervalued, probably up above $17 to $20 range would be ideal for the stock, but investors factor in the future, and if they're going to continue with these declines, people aren't going to be wanting to touch this stock, and it's going to hold where it's at up until they can show some sort of turnaround. Yeah, and the balance sheet here is the main factor for value, and that's kind of diverging away from everything else. That's growing the fastest. That was something that's changing this year, though, because their assets are down, and we'll see this year's number most likely take a hit because now they have a whole lot more to add to that balance sheet to be able to hit the target that we were expecting. But that's it for the stock. I read through the earnings. There wasn't anything super important in there, and uh, I updated the guidance and the year-to-date numbers. So those alone are telling us that it's risky. It's risky. So just on its face shows that we don't need to dig too deeply into the numbers. Maybe at some point next year, and they start showing signs of a turnaround, we could start actually looking into where the revenue streams are coming from and what they have to say about the company. But with what we're seeing here and here, and honestly, with this year so far on here, uh, it'd be a waste of our time. But I want to thank you guys for watching. Please like if you enjoyed the video. Comment if there's any other stocks you want to look at, or if you disagree with anything here. And subscribe so you can stay up to date with everything. And I'll catch you next time.